All right, well, I mentioned gold there. Spot gold price has been, well, it's been volatile, certainly over the course of the week, raising further questions about its safe haven and inflation hedge status. Let's get some thoughts on the precious metal. Davide Bosio from Shaw and Partners joining us now live. Davide, terrific to catch up with you again. So we were just, I don't know whether you tuning into that last conversation we had, but just about, I guess, how gold has been performing at the moment. And I mean, if you're a gold bug, I guess you would be frustrated, particularly if you're owning some of those local gold miners at the moment. Give us the lay of the land as it stands at the moment.
It's been a very, very interesting time, and I'll start by saying I've just helped my 14-year-old son with his economics homework recently, and he was telling me all the benefits of gold as a safe haven instrument that you can go to in times of uncertainty and fear. And so he's saying, "Gee, Dad, now must be a great time to buy gold." And I said, "Yeah, well, I've been doing that for some time and telling people the same, but continue to feel like we're getting it wrong at the moment." So it is interesting times indeed, and I think what we've seen in the markets over the last few weeks, in particular, a broad sell-off has led to, I call it the rush to liquidity, where all asset classes get sold off irrespective of what they are. And gold, as we've discussed before, is a liquid alternative, and it has, you can have physical gold, you can have ETFs, you can have individual stocks, etc. So there's lots of ways of playing gold. So we have seen the gold price itself come under a bit of selling and being hit with a bit of weakness, I think, as a broad sell-off across most markets. With that said, I think long-term investors need to stay true to the theme that gold is indeed a place of refuge, I guess, in times of high inflation and uncertainty. We certainly see ongoing concerns around, I guess, the geopolitical situation, particularly Russia and the Ukraine, as well as what's going on with supply chain issues in China. So we have all of those factors playing on or weighing on the gold price. Yet we're still travelling today. Last time I checked, we were around $18.40 an ounce, which is not too bad. We've bounced off those 1800 mark, and if you speak to any of the gold producers, although they would love for a bit more euphoria in the sector, most of them would probably say to you on the quiet, gold price around this level is fantastic for our business.
Just before we get into some of the gold majors, what's it going to take, do you think, for gold to break out of this range to the upside, given what inflation is doing and how central banks are tackling it with interest rates?
Yeah, I think we just need to continue to see, I guess, a continuation of this volatility in markets only fuels that fire. We know we are going into a rising interest rate environment. We know that we're in a period of incredibly high inflation, and I think periods of inflation, when you look to what that actually means, it's a reduction, I guess, in the value of the underlying asset or your purchasing power. So holding real assets, things like gold, remains a very, very strong theme. So I do feel that in the current environment and looking forward in the foreseeable future, I can't see all of this uncertainty and all the geopolitical situation unraveling overnight. So I do feel that we're in this kind of environment for a little bit longer, and I do feel that we continue to see investors taking advantage of precious metals as a sector. Although it does take time, I do feel that the only thing that's really going to give us a kick up in this gold price is probably a bit of euphoria, and that's euphoria in the sector. We've seen it in other sectors. We've seen it in some of the base metals plays. We've certainly seen it in the battery metals space, where every investor has an appetite for, say, the next lithium stock or the hot lithium stock. We've seen enormous amount of inflows in those sectors, but that's really, I believe, what we need to supercharge the gold sector. The only other thing that we could see, which comes out of left field, is just renewed M&A activity, and I do feel that that is a very, very strong possibility. If we start to see the gold majors coming out and really opening up the checkbook, that could get the mum and dad investor, as well as a lot of the institutions, starting to really reposition themselves across some of the equities.
All right, I'm interested to get your view on that specifically, but just, I mean, taking a look at where some of those stocks are today, and Newcrest up close to 2.5%, Northern Star 3.5%, Evolution up more than 5%. Which ones are you liking now, and why?
I'm gonna say that the sector is compared to its peers very, very much undervalued, and you know, Peter O'Connor, our mining and metals analyst in Sydney, who's often on this program, he talks about it regularly, and also we look at all the sectors in relation to each other, and looking at who seems cheap. And gold has been fundamentally in that what he calls the naughty corner. So they're trading at their almost 12 to 24 month lows in many instances, and looks like they are probably poised for a re-rating at some point. If we do look at the majors, they are always the ones that move first. So if you look at the Northern Stars, the Newcrests, the Evolutions of the world, they are in very strong position. They've been quite deliberate in terms of their asset acquisitions as well as divestments. So they've continually divested their lower quartile assets, say those that have probably seen their better years in terms of production behind them. So they continue to divest those, and they're always looking for the next company making assets to acquire. But then you go down the curve and you look at your companies like, you know, Ramelius, for example, which again we have a buy recommendation on Ramelius, but they are a plus billion-dollar company now. They've got a very strong balance sheet, little to no debt, and they have a number of operating mines, and they've been quite acquisitive. So, you know, I think we can see a number of those groups using their, call it, lazy balance sheets to go out there and chase more production. And that's a big theme that drives, I guess, the negative for those companies. Their paper is not expensive at the moment. So their shares are trading, many of them are trading at 25 to 30% lower than their more recent highs.
Yep.
So their paper's not expensive, but they do sit on a lot of cash, and typically they're trading with very little debt. So they have the ability to go out there and make some good acquisitions.
So if some of these majors are looking to boost their production, and you're saying that may well come via acquisition, which ones are you looking for? Perhaps, what are the most likely targets?
All those names that I mentioned are probably also targets, because there's always this is the problem when you're a big fish in a small pond like Australia. There's a lot of global players out there who can easily swoop in and take you over. And obviously we've got a very large gold market. We've got some of the best global gold companies in our backyard here, particularly in Western Australia. But there are some fantastic companies. And again, if you look at, say, a Ramelius, they've been quite successful in acquiring, call it, emerging operations or more difficult ore bodies or mines, and they've been able to work them very hard and turn those around. So they can start to contribute significant profitability as well as production into some of these existing producers. But, you know, there's also companies like De Grey. De Grey is a fantastic example of what a good explorer can achieve. And only a few years ago, they were a penny dreadful. Now, with a market cap pushing over $1 billion, they've got probably visibility to a plus 10 million ounce resource, and the market's waiting with bated breath to see how big the next resource upgrade will actually be. But that is a tier 1 asset in a tier 1 jurisdiction, being the Pilbara region in Western Australia. So it's going to be interesting to see if any of the larger companies swoop on those guys, although it's a development asset as opposed to a production asset. But what we do know is that all these companies that have existing production, they're consuming their inventory every single month. They are producing ounces. And the challenge becomes, how do we replace those ounces, because they are making great margins at today's prices. So how do they find their next production ounce? It is important, and so those juniors that are developing good ore bodies and good quality ounces, I think, are going to only become more valuable in this current environment.